All right, good morning. Bruce here from Targeted Wealth Creation. Happy 4th of July. Um, Hope you have a great weekend. I realize the markets are open tomorrow, normal hours, but at least you had a break, and I hope you're doing something you enjoy. Okay, so this topic that I'm discussing is actually how to hedge, complement, and manage your high yield income ETFs. So, who and what are high yield income ETFs for? So, I've done plenty of videos on the topic, income, how they work. So I'll refer to those inside this video with some thumbnails. I'll physically just copy and paste the thumbnail, but in the video, I'll put cards to link to those. But I want you to know what's already been done or say, well, you didn't tell us enough here. So, okay, let's talk about some of the fun. So I've covered Yield Max a lot. I will be reaching out to Defiance, Roundhill, SoFi, Granite, Curve, etc. There's a lot more competition out there. Clearly, Yield Max is early and strong in this. I think I saw them rise up to the 46th place in the ETFs. Listings based on assets under management is the way they define those. Um, okay, so you jumped into a high yield ETF or multiple ones. Now what? Well, mostly it depends on your personal situation. So, are you still working? Are you planning for a retirement? Are you so early in your work that you bought a few growth stocks, you're not really interested in income? Well, I'm here to talk to you a little bit about how they fit in a portfolio and whether you should be all in on just income funds. And a lot of it has to do with your situation, your expertise, whether you're actively managing, you want to just enjoy your life and be completely passive. So, another category would be you're retired and you want income from your savings. So, again, how much income do you need? Do you have sufficient savings to generate that income? Do you want to take a little more risk? Do you want to be conservative in your income ETF? Okay, or you're working now, but you want more income now to supplement the income you're getting from your job, career, or whatever produces you income. Okay, that certainly. And then again, what's your age? What's your risk factor? So I wanted to just touch on a lot of that. So the last category would be a younger person. They're broke, but they're wanting some income. So sadly, it's better to figure out some sort of work, some ideas, side hustles, how to find a job. So get out there and get in some kind of job, some kind of income producing situation, and then save. Try to live under your means. And I realize, guys, that may be difficult, that you may have to work for 3 or 4 years before you can really save some money. But once you start saving or living below what you really need to survive, then you'll have income that can generate income. So here's another cautionary tale to everybody. Please take caution when investing any monies in any security. For that matter, investing in anything. I've had some horrible losses in a few things that I did, but I learned from every one of those, and not just investing in the stock market. Clearly, from investing in the stock market, from issuing a market order instead of issuing a limit order. You name it, I probably did it. So that's how you learn, right? You learn through failure. So I've been doing this for a long time, 40 years plus. I was doing it really before the internet existed. So it was a different world then, right? Um, Brokers took on a whole nother meaning. You made a phone call, you did that. Somebody said, well, why didn't you just text them, or why didn't because we didn't even have mobile phones if you go back far enough, right? So I get that certain generations don't relate to it, but that's reality. This whole internet has really changed our lives, but so did the steam engine, so did the automobile to people that were riding horses. I mean, there's been innovation and things over the last 150 years, and there'll be plenty more. AI is all the rage now. Okay. So why now? Why me? Why should you listen to me? Well, I started this channel to help others. So I would say to you, in being cautious, follow someone that's traveled the road. And I got nothing against age. I could easily come out and say, well, why would you follow a Gen Z or a Gen X or a millennial? Well, there are some very successful young people in the world. So if they have success and they've built up money and know how to do it, then by all means listen to them. And I'll give you guys an example of a 25-year-old that I'm listening to right now. It's not in investing, but it is in a category I'll share with you in a minute. So it's nothing against age, it's about experience, right? If you see somebody that doesn't know how to walk the walk and talk the talk, and they're telling you, they're making $300 a month and you want to make 10,000 a month, why do you think that person knows how to help you? So I retired early because I saved and I invested wisely, but not always wisely. I mean, I had some expensive, you know, several failures in things that I did. The other thing, after I invested, after I retired, you really need to keep your mind active. I was always a numbers guy. I was an engineer early in my career. I moved into sales and marketing because I saw so more money there. And I explained how things worked from having been an engineer. So I sold that way. I didn't sell on my personality or that. I sold on my technical skills of explaining what that product or service gave back to that company and why they should even consider it, many times on ROI. So never forget this. I'll never forget picking a horrible ETF my first time when 401ks launched. I know I'm dating myself, right? I was back in my mid 20s. So, all of a sudden the HR came out in the field and I was running the sales for our software product in the Western states. And they said, okay, you got to choose. I don't even think they called it a cafeteria plan, but you got to pick within this family. Remember, there were Vanguards or Fidelities, and you've got to pick a fund. So I took it home and I studied it. And, the internet wasn't there. And I did the best I could with paper. And I figured out that there was a fund that did over 100%, right? It was an emerging market fund, and I saw what they produced in the previous year, and this was like May or something. So I jumped into that fund and, started looking at the first quarter. I said, oh man, I'm down 15%. Well, that fund had produced 100% plus return. Well, the year I had it, it ended up producing a minus 47% return. So being a math guy, I figured I went out and did my research and look at the numbers. But it just goes to show you, you can be half smart, you can know something but not know it all. There's a lot of hidden factors out there, right? So I always have this saying, don't look in the rear view mirror and expect to see what's coming up in the front windshield, right? They don't translate, right? They may. You're passing a big, long, farm, and you're looking in the rearview mirror, and you're seeing cows, and you look in the front, mirror, and you see cows. Yeah, that's a coincidence more than a fact, right? So age doesn't guarantee wisdom, but experience in having been successful through failure does. Age is also not relevant if someone has a proven track record of building wealth, etc. So I learned a lot. I knew nothing about YouTube other than I consumed information, immensely after I retired. Anything I wanted to know and learn, I just immersed myself in YouTube and learned it. There were many things I already knew, but like in technology, how do you keep up with things? They're changing, at a rapid pace. So I just watched and listened to YouTube on that, enhanced what I already knew, learned what I didn't know. So here I am in YouTube a month and I'm doing these videos and I'm cranking it out and I'm like, okay, well, how do I get more views? How do I get more subscribers? So I came across a guy that was 25 and I thought, oh, yeah, how does he know, right? And so I listened to him. He built 9 YouTube channels. He had one that was $1 million. He had 5 that were 100,000, sorry, 1 million subscribers. He had 5 other ones that had gone past 100,000. He started when he was 16. He struggled. By the time he was 18, he made more money than both of his parents collectively. So he literally learned most everything he needed to do. Now he's going around teaching people how to build a YouTube channel, like a lot of people do when they build expertise. So what the reason I'm doing targeted wealth creation is I've figured out investing fairly well. I wouldn't call myself the smartest guy, the best guy, but I've been doing options for 35 years. I've been investing, and over that time, you learn a few things, actually, a lot of things. So I love sharing that and helping people. So I thought I would tell you that I'm not prejudiced against youth, right? Especially youth that learns and has a track record better than I do in something. So I'm happy to do that. So let's jump into income investing from the myth standpoint. Okay. Here's the common myths that you'll get from people that are maybe growth oriented or they don't really understand, high dividend, high yield ETFs. So they say things like, well, it's better to own the underlying security, which can be true. But if you just take that for granted, that's entirely not always true, right? There are situations that make it truer and falser, if we want to say that. And then they'll say you have 100% of the downside. That's also a false statement. Okay. But I need to show you, there's false narratives that need to be debunked. The other classic one, the first two you'll hear, better to own the underlying three. They have 100% of the downside, which is not true. Now, they may have 92% of the downside, they may have 95%, but they really don't have 100% of the downside because you're being paid every week to hold that. And so if something that you buy goes down 100%, you probably and really won't go down 100%, but you will go down a lot. Okay, you're not immune to that. So people always say, are there risk in a high yield fund that does synthetic options? Again, it's not just YieldMax. There's several other companies. As a matter of fact, the options executor, Zega Financial, people are always talking about Jay and interviewing Jay. Well, Jay's not YieldMax. Jay has his own company, right? It was the head of retail trading for Ameritrade. So people are quoting him now and they're telling everybody, well, Jay said this, right? Jay's a bright guy. He's written a book. You talk about an options guru. So his company lends itself to private individuals, right? 6-figure, 7-figure, 8-figure kind of people. They want somebody to manage their stocks and write options and create, put collars on for different protective. So the beauty of that is it's now available in retail. But it goes back to that false narrative. There's just a lot of things that are said out there that aren't true. Jay's not YieldMax. He's just a sub advisor. He's CEO, co CEO, actually, of Zega Financial. And they do the option trading within YieldMax and some of the other funds. And then there's other companies that do the administrative portion. And then, you hire a lawyer, a legal firm, you hire an accounting firm, right? You make sure you adhere to all the SEC stuff. So these are just how ETFs are put together today with a lot of different resources. So I don't take Jay as the sole source of everything about YieldMax. Again, he and his team are managing the options and have a lot of expertise and are very talented. But understand what that is, okay? So any purchase in a decision in a YieldMax, for instance, ETF, or any high income ETF, covered call. And by the way, it always grates me like, um, I forget what I was trying to say, but it just gets under my skin when people, and it started with the very people that created it, they call it a income covered call strategy. Okay. It's not a true covered call, it's a covered call strategy. Okay. So please understand the difference. And I get that the lingo, everybody just refers to it as a covered call, but in no way do they own any underlying stocks. So by the real definition, you can't cover a call, right? If you buy a stock and you write a call, then that's a true covered call. But when you just do it for income, it's really a naked call. And that's why it gets capped and everything else. But if you want to present it as, I've got a synthetic that's pure long, right? I buy a call and I sell a put, those are both long stocks. So that's a synthetic long stock position. And then I sell naked calls, and it gets referred to as a covered call strategy around protecting the synthetic a little bit. So you're going to get some income if the fund goes down. In other words, the underlying and the synthetic loses value, but you're collecting some other money. So that's just my personal little bugaboo that when I hear that, it's always bothered me. But I understand what they're saying and doing, but it isn't. There are income funds that are true covered calls. They buy the, matter of fact, in Ulti, one of the Yomax funds, mostly, and it looks like always now, they're buying the underlying stock and they're writing a true covered call, but just different than a covered call strategy on top of a long stock synthetic. Okay, so what happens, and by the way, guys, this covered in Yomax for beginners that I wrote over here. So I made a video, it was very well received because I got tired of seeing what other people tried to say, and it was super technical stuff, and drawing pictures and explaining calls and puts and all that. So I just thought I'm going to answer all the questions that people ask me all the time. Should I buy this? Should I invest in this? What is it doing? How do I know? Am I going to get NAV erosion? Am I going to get a reverse split? Yeah, all of those kind of questions. They're all great questions, but they're all complicated. They're no just straightforward, simple answer. Okay, so let's jump back into it. Please know, and I say this in my other videos, there's some haters of, in particular, of Yieldmax, right? Because remember, its very first fund, that and ARC, right? They had a Tesla for Tesla and ARC or ORC for ARC. And both of those over time are barely positive now, and I'll show you some of that. But the big problem is you can't protect an option income fund if the underlying goes into a bear market. If you go buy Tesla at $200 and it goes to 100, you lost 50% paper value, right? You haven't lost it if you haven't sold it. Well, you're going to just about mimic that in your yield max Tesla fund. However, in theory, and usually it works that way, I can explain some of the nuances where it's slightly different. You will have made the income on the weekly naked calls, and that will offset some of the drop. However, in some fairness to those that at times are correct, when a stock goes up very quickly, I'm talking 25% in a week, 50% in 3 weeks, you are going to outrun or you're going to get capped, as it's known, on those weekly naked calls. So you're going to lose money on those. You're going to do even, you're going to do just like the underlying did with your synthetic, but you're being dragged down, right, by the naked calls. You're getting run out, and they're giving you a certain amount of money for writing it, and you're having to pay 2 times or whatever or more to buy it back. So what's positive in some situation keeps you from rapidly rising. If you told me tomorrow a stock's going to go up, in the next week 60%, and I had a choice of what I went out and bought, well, first of all, I'd buy options. But second of all, if I had to buy an ETF, I would go out and buy a 2x ETF. Why would I buy a single, right? because the underlying is a single. Why not just go out and buy a 2x ETF that performs the same as double whatever the underlying is? So people will tell you the underlying always outperforms. It doesn't. With these weekly calls where you're collecting the money, if in fact it goes at a slow rate, let's say it averages 3 to 5%, and they're writing the calls out at 6 and 7 and 8%, then every week you're going to make all your income. Your synthetic is going to keep going up, and you're going to do awesome. But if they combine 10 weeks into 1 week, you're not going to do so well, right? So there are just nuances related to these income funds. Some are great, some aren't so great. So you watch and learn. Okay, so those same persons wrote Tesla down significantly. So who are they going to blame? What do most people do when they FOMO in at the top, which is what naive retail buyers do? And then all the smart money is already sold, and then something crashes 50%. Then they get, oh my God, look how bad I am. How far down it's gone. So they sell. A year later, it's back to where it was or up 50% more. Not every, you can have one that just goes down and dies because you bought some little tiny company. But typically, your very large S&P type 500 companies, very few just go out of business overnight. They may have a downtrend. I remember in the tech industry, I did software install for Polaroid. Who even remembers Polaroid, right? I do. I owned a Polaroid camera, but most people never heard of it. Not with today's, cameras, which are more powerful than computers were 10 years ago, let alone computers from a long time ago. So there's always, things that get outdated, that stop existing. So you always want to take a look at the underlying stock that your income fund is sitting on top of. So in YieldMax, like in some of the other ones, they can go out on an index like QQQ. And YieldMax, they have the Magnificent Seven. So you have a collection of 7 stocks. They also have all the single stocks. So your yield is typically 40, 45% across that board, because now you got pharmaceutical, you got tech, you got oil, you got precious metals. They got a lot of variety, but I would say still a large percentage of tech and Bitcoin and that. But you do have some pharma, you do have some other industries. So for long-term yield investors, why is these funds even here today, and where did they come from? Are they just a ruse? Are they a scam? Are they going to go away tomorrow? Well, for somebody that's been investing for a long time, yield investors forever. I mean, they still exist. You go out there with a Charlie Munger type. I mean, he's an exception because he was extremely wealthy and did it. But say you got somebody that's their grandfather and they've owned AT&T for 50 years, 60 years in their portfolio, and they're bragging about, well, I'm still getting 3.5% a year. And, they own their original stocks. Maybe they were dripping, reinvesting, and they got millions of dollars in there, right? Well, that doesn't seem very efficient today, but that's what used to exist. So as these markets took additional risk, derivatives were created, and we're now in this options market that we have. I remember when options were nothing but monthly settlement every third Friday of the month, right? Then we went to weeklies. Now we have some dailies, right? You have the income funds, ODT, and all these that settle daily and produce income daily and pay you weekly now. It's got to be an administrative nightmare, but that's where Title and these other companies that do it for YieldMax and Defiance, I think, and several others. Again, there are like firms that do nothing but help ETFs do tasks, be it option trading, be it website, be it administrative, being payments, etc. Just advise them how to operate, right? So you're seeing a plethora of startup companies. And many are former management people from the big guys, right? That want to go out on their own. I don't blame them. I mean, I saw it in the software and hardware industry I was in for 40 years. So, um, how do you manage ETFs? Okay. Well, I personally, just because of my skill set and things, I like this. This is fun. That's why I do a YouTube channel. I want to help people, right? Um, so I actively manage my high yield income ETFs, right? So I put a video out. See my video titled How to Hedge? Because when I talk to people, they ask me a lot of the question, well, Bruce, which fund should I get? Well, which fund are you bullish on? Well, what if it goes down? Well, what if you buy, have you ever bought a stock? Yeah. What do you do when it goes down? Well, I put a sell stop. I said, okay, well, you can do the same thing with an income fund, right? But nowadays, with algos and everything else, sometimes they run sell stops. They're always searching liquidity. So I'm not saying don't do that, but and then I have videos out about, well, how do I buy my ETFs cheap? Well, I sell puts, right? A lot of people don't have that capability in their account. They don't know how to do options. Okay, so a lot of these people now, Yieldmax and Defiance and Granite and some of these others are going out there and they're creating inverse funds. Okay. You're going to ask me, what's an inverse fund? Many of you know, but a lot don't. So Tesla, Yomax had Tesla. So they came out with Crash, CRSH, right? Some people call it Crush, but I love the Crash, you know, name. It just plays well with the FSD and everything else. Although I'm very bullish, I got to tell you, I just loaded up on Tesla, a week ago or so at mid 15s, and already it's high 17s now. Let's see. I think it's turned the corner. I think once they paid Elon and he came out, he's very motivated now to get it going. It doesn't mean it's not going to have, it doesn't retrace. That's another thing. If you buy these things, don't go all in the first time with all of your money. Buy in batches, right? Because everything's volatile. Just look at the stock market, look at the political, look at the geopolitical of the world. Everything is just crazy. So anyway, I put out videos how to hedge Nvidia, how to hedge Coney, how to hedge Misty. All of these things can be hedged. So what does that really mean? Well, think of it as an insurance policy. You'll get it. Go out and look at this video. Again, I'm going to put the cards so that these will appear on this video. But worst case, you can go out and look at my channel and follow and find this actual video by seeing the thumbnail here. Okay. So sometimes it's simple. And then honestly, people come to me and say, okay, Bruce, I want to hedge Coney. Okay, I like your strategy. I know how to do it now. Well, how much of the hedge should I buy? Well, some of that is personal. I'm not your financial advisor. I mean, I may set up some, Patreon or something a year down the line, but right now I'm not motivated for the money only. I'm just trying to build the expertise here to help people. But yeah, if I've got to expend a lot more time, then maybe that's what I do. Follow me, or this is how I do this for some small, monthly fee. But I'm not in it really for the income. I mean, I put out a video that said, this is how I make $40,000 a month on under 400,000. Now, again, does that mean every single month? Maybe it's 38, maybe it goes to 43, maybe it goes here. The other thing by actively managing, a couple of months ago, I saw Coney not having as good a month, and I sold, 80% of my Coney and put it all in Misty because I knew they were going to have a better payment, and they did. They paid 303 that month, right? So you said, well, did I go back in Coney? Yeah, but with other monies from other dividends that were paid. I don't really drip them, but I just reuse them to go other places. And then I took some other capital and bought into Tesla recently. So if you want to active management, you can. If you really want passive income and you have plenty of cash investment stuff, then I say go out and buy something like, YMAX, right? Which is all the funds. It's a 40% yield. It's not going to keep up with NVIDIA and Coney and Misty and some of the other 70, 80, 90% payers. But again, nothing is consistent. So I also utilize, and I mentioned this, leverage ETFs only when I see a chart situation signaling a high probability retracement or impulse wave up. Again, that comes from just years of experience. So what does that really mean? Well, that means, the guy that tells me, hey, you're not going to keep up, take MicroStrategy. And they have a fund called Misty. So just look at the IV on it. It's one of the highest IV companies out there. So Michael Saylor, brilliant guy, proponent of Bitcoin, has taught many companies. I see Michael Dell now at Dell. I used to work for EMC, which merged into Dell. But you talk about a company that now Michael Dell is saying, hey, yeah, I've been sitting on treasuries forever. They don't pay a lot of money. Maybe there is something to putting a lot of our treasury. Well, when you're talking about, $100 million company, that can be significant cash. So Michael Saylor is trying to show people he's done firsthand, right? So he's a spokesperson. So anyway, MicroStrategy moves very well with BTC. Some people argue that it shouldn't have the premium over BTC that it does, but they own a lot, right? Their software revenues are minuscule at this point because they've evolved out of their old area and they're doing more and more things about Bitcoin and adoption and payment systems and a lot of things around that ecosphere. Again, I'm not really a bull on crypto. I'm a bull on BTC because I think with its limit and a lot of other things that have been done there, I think that's the bull factor. And I think that goes way, way up in time, through the adoption methodology. So again, see my video on YieldMax for beginners, the hack to 117% annualized passive income. And I just talk about what can be done, right? So here's a monthly payout. So you want to figure out, well, how much do I want to make? If I want to get 5,000 a month, how much do I have to invest? And then I say how you can make 8 to 16,000 on an investment of 100,000. How you can make 3,000 a month, but you want to do this one safely. You really don't want to have to watch it. You want to just kind of put and again, is something safe. Listen, you can go out to the safest thing in the world. I'll never forget 2008 when we had that whole Lehman Brothers. For all of you people, this brings out bad memories. It does with me, right? Um, I remember calling Fidelity around my 401k and saying, hey, is the money market $1 representation going to be safe? And I just pinged them and pinged them and pinged them because there had been some other people with money market that said, hey, you got 30,000 in money market, but it's only worth 26 because the dollar value isn't a dollar anymore. So, there's certain things we take for granted, just like the fiat money, right? You pull a dollar out of your wallet. Does that really have any value? What's the value of a dollar? Well, it's worth a dollar. We all know it doesn't buy much. It buys 3 cents, as much as it used to buy, a dollar 80 years ago. Now it buys 3 cents worth of what a dollar bought back then. So, but it's still a dollar. But it's the faith of the government behind it, right? So a lot of these things are the faith of the stock market. If you think the stock market, and I get those people all the time, the chicken little, the sky's falling, we're having a 1929, and do I think we could have a 20% market? Anything over 15 is a crash. Yeah, could easily happen. Do I think we're going to have a 90% right now and go into 1929? Absolutely not. Does that mean that'll never happen? I don't know. There's black swans or geopolitical events, there's world war, there's nuclear. There may be a nuclear war where it doesn't matter to any of us. Who knows, right? But probabilities, right? So anyway, I have all these different videos. They're out there. The cards will be in here. Let me move through this faster, okay? It's getting long in the tooth. So here's some recent stats, because here's one that people ping me with all the time. Well, Bruce, I heard it's return of capital, and I'm just going to get a reverse split, and I'm going to lose all my money. It's a scam. No, no, no. Okay. If you buy a stock, can that stock go to zero? Absolutely, it could. Do I think it is? Do I bet with my money that it's not? Yeah. So let's take the bull in the china closet. Let's take the one that's had a reverse split, right? So here's Tesla right now. What's the current price? $17.77. Well, since you had a reverse split and all the funds come out at $20, right? That's their initial inception. So I put the price, if you bought it in November of 2022 and it was over $200 on Tesla at the time, which it proceeded in a few months to go down to 100. So you lost 50%. So Tesla today, because the distributions, right, over that 17 months, actually it's 19 distributions, right? Because when you go a year, it's usually 13, right? If you go June to June. So they've had 19 distributions, counting the one that's coming up that was declared on July 3rd and will be paid on July 8th on Monday. They will have returned $24 in distributions. So add that to your 17, and you now have a total of 4.42% return. Not a great return, right? But how many of you ever invested in something and a year and a half later you lost money? Okay, I think everybody's hands that have invested would have to raise them. If you're telling me you've never had a loser, you're lying. Okay? So that's not great. But what if from now on, over the next 2 years, Tesla goes up an average of 30% a year? So all of a sudden, now you have a capital gain, right? You had this big loss to overcome and you got income to overcome that. Look at ARK. So I picked the two worst performers and I put them right up here at the top. Okay. They've had $9.37 in distribution. Their current price is $10.88. Nobody else is reverse split. I think somebody said Tesla got down to $5, $7, $8. I don't know. At some point it's going to reverse split. So if ARK keeps going in this direction, it'll reverse split. But bottom line is they don't all just do that, right? It's the underlying that drives that. So they've had $9.37. What's the total return in the same, 18, 19 months of ownership? Not good, right? But everybody said you lost all your money. No. And they were probably, I guarantee you, there were some Tesla people that sold out that took a 30% hit because they didn't have the distributions over the last 4 or 5 or 6 months and they sold, right? So, let me ask you this. If you go buy a piece of real estate and you rent it out, and a year after you rent it out, you find out that all real estate in your area is down 35%. Do you go sell the house? Well, what if your rent's the same as when you started renting? So, and then what if in 5 years later the house is up 20%? Now you've collected all that rent. So it's the same thing. If you're bullish, again, if you see something, learn something in that stock that you no longer think it's a credible company, by all means sell it or set stop losses if you feel that strongly. Okay. So here's another one. NVIDIA. I mean, that is the stock market right now. Everybody's running around. NVIDIA's the goat. NVIDIA's the goat. NVIDIA. Yeah, hello. But I spent a lot of years in hardware, and nobody, and I mean nobody, has more than a 3 to 5 year run on hardware. I said this, and somebody said, "Oh, Bruce, they have software." I'm talking about AIP software. I'm talking about the kind of software, ontology, platforms that can transition a company from doing just chat GPT by spending millions on their GPU hardware in their data center to where they roll out transportation, logistics, supply, you name it, all financial, um, human resources, every single thing gets transported and digitized and improved. So you optimize workflow throughout the organization. For that to happen, you need software, AI software. Okay. There's very few companies that are good at that. Snowflake down here on the bottom is one of them. I happen to like Palantir. It's expensive, but it's world class. Okay. So those are the companies that are going to follow on. NVIDIA is going to have a nice run. They've had a heck of a run. But if I look at it, NVIDIA, and I say, is that going to be a 20x from here in 3 or 4 years? Absolutely not, right? They're getting margins, 10 times what people can get. And those eventually will erode, right? I told somebody, well, yeah, but Bruce, their new one is 25% less power. I said, but they don't make all their chips. They're also dependent on the TSMCs and other fab companies. They do some integration and some customization. They're a great company. They transitioned from being the GPU for gamers at the retail market into AI and all that in the cloud and all of the servers. So they are the hot ticket, right? And no question they're going to do well. But I don't think they're going to do as well as a lot of software companies that are coming on in that space, because the software company can maintain 80% margins throughout the life of its software. A hardware company may have 300% margins, and when the rest of the competition catches up and the other suppliers, then all of a sudden they're operating at 20 or 25%. So that PE and those, it just doesn't translate. But I'm not saying it's not a great company to buy or own or income. Look at it. It's 139%. But go look at this if you want to see this. Okay, so it's had 14 payments. Go back and look at its first 6 payments. I don't even think it got to $1, right? I mean, here it is paying 247 in the last payment, and look at its average. Its average is still $1.33. Again, the other problem you have when they get really hot and they run hot, then truly the underlying performs better. So when you saw NVIDIA start to run, that was the time to go buy your 2X ETF and then still hold on to your income ETF, right? So now you're still getting paid every month if you want income, but now you're really getting the gains, right? So if somebody, I can turn that argument around on the guy that says own the underlying. No, own the underlying with leverage, right? So there's a lot of situation. Great company. I'm not knocking you. That is the stock market right now. It's a little scary in itself. So the BTC and the funds here, you've got Coin, right? And Coney is the Yomax fund. You got Mister, and you got Misty. Again, a lot of other companies are starting to have these. I'm going to start reporting on Defiance and SoFi and Curve. There's a lot of other good ones out there. I just had focused on Yomax, but they're by far not the only guy. So look at these, right? 139% total return, mainly because NVIDIA has just taken off, right? There's no question. That was a $20 14 payments ago, right? 14, 15 months ago, like all of them, it came out at $20. So it's paid $18.60 in 14 distributions. So it's average $1.33. But here, if everybody thinks it's a goat, look at Coney. All right. So Coney, oh yeah, it's only $20.93. It's been $30 a couple of times. It seems to go up to 30. It comes back to around 18, 19, goes back to 30. We'll see what it does. Right now, Bitcoin's down a little. So they've had $18.52 in 10 payments. So I would argue that they've outpaid NVIDIA. Okay. They haven't outperformed them in total return, but probably 10 months to 14, if I annualize this number, they're probably much closer, right? Because 10 isn't 12. So I'm going to go up over 100% in annualized return. And this one has 14 months in its calculation because I did a simple total return. This is going to come down for 12 months. So all I'm trying to say, and how about this? Now it's 4 payments. This is the GOAT. When everybody touts NVIDIA, and NVIDIA deserves it in a lot of ways, okay? This has had 4 payments. No other Yield-Max fund in any single month has paid $3 or $4. And Misty, out of 4 payments, has had 2 payments that were $2, $2.52 and $2.33. They had a $3.03 and a $4.12. So they are the GOAT, the absolute income GOAT. Now, can they sustain it? That is the $1,000,000 question. So I own a lot of Misty. Why do I think they can sustain it? Or heck, I mean, it's unrealistic that they're going to have a $3 average a year from now. They're probably going to be 2, but so what? Do you realize what kind of return that is? Again, they've been as high as almost $40. They were up at 39 and they're back to 27 again because BTC is trending down. It's 59. I think BTC in their term is going to 52. If it hits 56, which is the 50-day moving average, I think it's headed down to the 200-day moving average, right? So it's just it needs to get going, and maybe it will, and I'm sure it will over time. After these halvings, traditionally it's 6 months to 18 months is when you get all the gains. We'll see. All right. So anyway, I just threw a random group in here, and here's Snowflake, right? They've had one payment. I didn't even think they were going to pay because they didn't quite have the full month. They had one payment of 93 cents. They're trading at 21.60. So they got a 12.67 return. So just think if they maintain 21.6 and next month they pay $1 or something, all of a sudden this starts going up, up, up. And that's what happens when these companies do well. But again, your risk is the underlying. All right, let me move through. Here's something I put together many times, and this goes out, and these are in my videos. So the reason I put those thumbnails there and I'll put the cards is I want you guys to see how these all work, right? So this is just an image of this spreadsheet as opposed to the real spreadsheet. So these go all the way back because ARK and Tesla were the first two, right? In January of 23 when they paid, and you start looking through all the payments, right? So remember I was telling you about Misty, 412, 252, 303, 233. So they paid $12.01 in 4 months, which is an average of $3. Just crazy. No other fund, including NVIDIA, has ever paid $3, right? Look at some of NVIDIA's payments. 247, 256, 119, 260, 262, 153, 56, 62, sorry, 51, 42, 68, 93, 81, 96, 75. I mean, it's a great company. It's done really well. But again, when it starts running now, based on its stock performance, you'd think it'd be paying $3 or $4, but it gets capped. It runs by. So again, the underlying is better to own, but how are you going to get income? Do you want to sell off stock and have to pay capital gains? Yeah, I know. You get taxes, ordinary income. That's a whole nother subject. I've got some videos coming on that. Okay, guys. I think that I'm going to give you one more. The other thing I did in some of my other videos, and you can see in those, is I said, well, if I want to invest this much, again, now this data is 2 or 3, 4 weeks old, I go through and I say, what's the current price? Okay. Like Misty's not 29, it's 27. Coney's 20 point something. They're close, but they're not the exact numbers. And then I say, you want to invest this much, then you'll buy this many shares, and this is the kind of income you'll have for that month, right? So I use a lot of these things to tell you that. So that's really the straightforward, right? You invest $7,500, you can get $822 based on Misty. You get $775 based on Coney. Blah, blah, blah. You just go through the list. Okay, guys, so I wanted to get this out. I love to educate. Again, this is not financial advice. I'm not a financial advisor. I'm just trying to educate. Okay, guys, have a great weekend. Bye.